Hey guys, welcome back to my YouTube channel. My name is Mary Gatti and I welcome you to another episode of Personal Finance. So today we'll be discussing the stock market and the principles that you need to know before you start investing in the stock market. And this is according to the almighty Warren Buffett. So basically, before you start investing in the stock market, you need to make a conscious decision that you want to invest in the stock market and be willing to put in the work upfront that is needed for you to understand the world of stocks. So I'll be dividing the principles into 4 categories and hope you're going to enjoy this video. So before I start, I'd like to tell you to like the video down below. Don't forget to subscribe and also follow me on Instagram at Merigati. So with that said, let us begin the video. So in Kenya, we have very many stocks and shares and equities that you can buy. So guys, the first principle before joining the stock market in Kenya, according to the almighty Warren Buffett, is only buy stocks that you understand. So what does he mean by only buying stocks that you understand? So this means buying stocks from sectors that you're familiar with or sectors that you understand how the business runs. For example, if you're in healthcare, you probably understand how hospitals run. So it's advised that you invest in a sector that you understand and also invest in products that you love and products that you love using. So proper research is needed for any specific company before you start investing in their stocks. This is because you're becoming a stakeholder and an investor in that company. So you need to understand the gears that run the company, how the company is doing, how their products are doing in the market. This includes checking the stock viability, checking how the prices have been fluctuating maybe over the years, and this is usually maybe coupled with how the business has been running over the years, if they are still maintaining their customer base or they've been losing clients. Also by checking the business models of the companies that you want to invest in, check their advantage over their competitors. Like if you want to invest in company A, how is company A faring against its competitor, company B? Also, you check customer loyalty to the company and to the product that the company that you want to invest in is producing for its customers. For example, in Kenya, Safaricom has a very good customer loyalty because of the services they offer, like for example, M-Pesa, and also the M-Shwari saving account, and they also offer M-Shwari loans. A company with very good customer loyalty is a good company to invest in because such companies always promise high returns. Also look at the company's strengths and earnings. So if the earnings are going up, it means that the company is doing very well, and that would be a good indicator of investing in such a company. So if you're someone who's looking for investing in long term, you should check for companies that offer dividends. This means that the amount that you invested in that company will be earning more, which will be paid to you maybe over the years. So also you have to be careful maybe about dividends, and something that I like to look at is if the company is paying more dividends than it's retaining for its growth. I usually see that as a poor indicator of investing in such a company, because it means that the company maybe might not be reinvesting in itself for growth. Also remember to check out the total liabilities and total assets, which include long-term and short-term assets of the company. And if the long-term liabilities are higher than the long-term assets, that could be a poor indicator of buying the stocks. Or if their long-term assets cannot cover for their short-term liabilities, then that could also be a poor indicator for investing in that company, and I would be a little bit reluctant to invest in it. So the second principle that you need to know before you start investing in stocks in Kenya is the principle of buying and holding. So buying and holding is a strategy in which an investor buys securities or stocks and holds them for a long time, regardless of the ups and downs of the stock market. So according to Warren Buffett, he advises people to buy stocks and hold them long term from a great company that is starting up when on sale, and then hold the stocks long term. Personally, I usually prefer the buying and hold method for companies that offer dividends. According to me, holding stocks with dividends is the best, since you'll still be earning money every year on top of the money that you invested without really selling your stocks, and your money will still be basically working for you. So it's also good to buy something that you'll be happy to hold for a long time, even when the market goes up and down and that sector maybe collapses or goes down in economy. So also remember, the longer you hold the stocks in a great company, the faster it grows. And this is due to the principle of the snowballing effect. So what I mean by the snowballing effect, this is a state where something starts as a small thing. Maybe when you started investing, you put little money in your investing, and then it just grows exponentially. So that is the snowballing effect. Buying and holding also reduces the stress and strain that one gets from day trading, as you wait for the stock market to fluctuate, to go up or down, so that you can sell your shares. So it helps avoid those stresses of day trading. Number 3, we are also reminded to invest using facts and not emotions. So you only get facts when you do proper analysis of the companies that you want to invest in. We are advised not to get emotional about money and not to jump for the next best thing that comes out without doing proper analysis of those stocks in that company. Find out about the product, the customer loyalty to that company. Do you like the product? What is the potential growth of the company? And also make a point of checking their financial statements. They can actually provide a great insight for predicting the future. So the emotions that are involved in investing include fear. Fear of losing while investing might make some investors withdraw or sell their shares too early so that they can lock in the profits that have come from the share prices going up. This usually is a defense mechanism against depreciation. Maybe you have invested a certain amount of money in a company. So if fear takes over you, you'll want to sell your shares. Immediately the stock prices go up because you're afraid your money is going to depreciate once you hold the investment. And this may make some investors make mistakes of selling winning shares and retaining losing shares. So just because a company's shares depreciates does not mean that your shares are going to depreciate all the way to zero. So companies usually depreciate and appreciate all the time. So patience in the stock market is also advised by the almighty Warren Buffett. So another emotion is overconfidence during investing. For example, you invested maybe 10,000 in a company and get a 20% return on your money. This means that you'll be overconfident about trading again, and it might make you think that you're a good investor and that you can invest in anything and get high returns. So this leads to a mistake of overtrading so that you can make more money, and you might end up making more mistakes during your investing or during your analysis process because maybe you refused to take a step back and analyze the investments that you want to invest in later. Another emotion is poor self-control, which usually impedes a lot of investors from achieving their long-term goals in investing. So poor self-control makes us want instant gratification and instant returns from our investments, and we cannot wait for our investments to compound, and hence we end up taking risks that are going to cost us in the long run because we do not take a step back and analyze our investments. Point number 4 of principles that you need to know before you start investing, according to Warren Buffett, is diversifying your portfolio. So a portfolio is a range of investments that are held by a person or by an organization. So having a well-diverse portfolio is the way to go in 2021. So diversifying your portfolio is usually achieved by having different shares at different sectors of the economy. So why is this important? Having a diversified portfolio helps you spread your risk among different sectors. For example, telecommunication, if you buy shares from telecommunication, from banking, shares from the agricultural sector, shares from the insurance sector. So this does well to diversify your portfolio. The advantage of this is that if one sector was to go down, you have other sectors making profit for you and holding on to your investments. Also, it's helpful to diversify your portfolio among different countries because your country's economy might be performing poorly during certain financial years. So invest in also different countries which have emerging markets and new consumer base, because these markets tend to go up very fast before stabilization happens. So something else to note is to do not diversify more than 20% of your portfolio or more than 20% of your investing income in just one sector. So why is this a point of consideration? This is because something might happen that crashes the sector that you invested in. And honestly, you do not want to obliterate and eliminate your whole portfolio from one sector that did not perform properly. So I also believe in not investing in too many stocks because I will have so much to handle that comes from checking your stocks all the time. So these are some of the 4 basic principles that I learned before I started investing from some of the greatest investors in the world. And I thought that I would share them with you so that you can also use them before you start investing or before you start your investing journey into the stock market. So with that said, we have come to the end of the video. So don't forget to like the video down below, click down at the thumbs up signal down below and like this video. Also don't forget to subscribe down below, and don't also forget to press the notification bell icon, the one that looks like a bell, so that you get notified whenever I post a video. With that said, I will see you on my next one. Bye!